the US dollar. That mighty greenback, the bedrock of global finance, can be a fickle beast. Like a chameleon adapting to its surroundings, its value fluctuates, impacting everything from the price of your morning coffee to the performance of colossal corporations. Picture a seesaw, if you will. On one end we have the US dollar, on the other, the American stock market. Now, imagine the dollar gently dipping, losing some of its weight. What happens? Surprisingly, the stock market, that behemoth of investments, often rises in response. A curious correlation, wouldn't you say? But why this inverse relationship? Why does a dip in the value of the dollar often translate into a surge for American stocks? Join me, dear viewers, as we delve into this fascinating interplay and uncover the truth behind this intriguing financial phenomenon. Now, before we venture further, let's clarify this notion of a weakening dollar. It's not about the physical dollar bills disintegrating in your wallet, mind you. No need to rush to the bank just yet. When we speak of a weakening dollar, we're referring to its exchange rate against other currencies. Imagine the dollar as a contestant in a global dance competition, constantly twirling and swaying with its partners, the euro, the yen, the pound, and so on. A weaker dollar simply means our contestant has lost a bit of its footing, and its partners are looking a tad more graceful. In essence, it costs less for those holding other currencies to buy US goods and services. A boon for some, you see, but a potential pitfall for others. The impact of a weakening dollar ripples through the American economy, touching nearly every corner of the business landscape. It's a shift that doesn't just affect Wall Street or currency traders. It reaches into factories, warehouses, and even the pockets of everyday consumers. When the dollar loses strength, the effects are felt far and wide, setting off a chain reaction that can reshape the fortunes of entire industries. This change is particularly significant for companies engaged in international trade, where the value of the dollar can make or break a deal. The stakes are high, and the outcomes can be dramatic. Imagine, if you will, two distinct tribes, each with their own hopes and fears, the exporters and the importers. Their destinies are tied to the dollar's dance on the world stage. For the exporters, a weaker dollar is akin to a favorable tailwind, propelling their ships across the vast ocean of global commerce. Suddenly, their goods become more attractive to buyers overseas, who can now purchase American products at a relative bargain. Their products, priced in US dollars, suddenly become more affordable to foreign buyers. This competitive edge can open new markets and strengthen existing relationships abroad. Demand surges, orders pile up, and profits soar. Factories ramp up production, workers clock in for overtime, and the hum of industry grows louder. It's a time for celebration in the land of exports. The mood is upbeat, and optimism fills the air as businesses ride the wave of increased global demand. The importers, on the other hand, face a different fate. For them, the weakening dollar brings a set of challenges that can't be ignored. Picture them as weary travelers returning home with goods from distant lands, their wallets feeling a tad lighter. Every transaction abroad now costs more, and the math just doesn't add up like it used to. A weaker dollar means they must now shell out more of their precious greenbacks to purchase the same amount of foreign goods. The cost of doing business rises, and tough decisions must be made. Costs rise, margins shrink, and profits dwindle. Some may even be forced to raise prices for consumers, risking lost sales and strained relationships. Not a time for merrymaking in the import business. As the dollar's value shifts, so too does the balance of fortune, reminding us that in the world of trade, every change in currency brings both winners and losers. The saga of the weakening dollar and its impact on American companies is replete with tales of triumph and tribulation. Take, for instance, the mighty Boeing, that titan of the aviation industry. A weaker dollar makes their airplanes, those marvels of engineering, more competitively priced in the global market. Orders pour in from far and wide, their factories hum with activity, and their stock prices soar. But alas, not all industries bask in the sunshine of a depreciating dollar. Consider the plight of American retailers, those purveyors of goods from across the globe. A weaker dollar means their costs for imported merchandise skyrocket. They're caught in a bind, forced to either absorb the losses or pass them on to consumers, risking a drop in sales. And so it goes, dear viewers, a perpetual tug-of-war between the winners and losers in the grand game of currency fluctuations. Now, let's cast our gaze beyond American shores and delve into the minds of foreign investors, those intrepid souls who navigate the turbulent waters of international finance. These investors are constantly on the lookout for opportunities, but also wary of the risks that come with venturing into unfamiliar territory. Their decisions are shaped by a complex web of global events, economic trends, and shifting currencies. A weakening dollar presents both an opportunity and a challenge for these savvy players. On one hand, it can make American assets more attractive, lowering the price tag for those buying with stronger foreign currencies. But on the other hand, it signals potential instability and raises questions about the future value of their investments. On the one hand, American assets, including stocks, suddenly seem like bargains. The drop in the dollar means that for many international investors, their money now stretches further in the US market. Imagine a grand sale at your favorite department store, but instead of clothes and appliances, it's shares of Apple, Microsoft, and Amazon, all marked down. For investors abroad, this can feel like a once-in-a-lifetime shopping spree, where blue-chip stocks are suddenly within easier reach. Foreign investors, sensing a deal, might be tempted to swoop in and snap up these seemingly undervalued treasures. The prospect of owning a piece of America's most iconic companies at a discount is undeniably appealing, and it can spark a wave of international buying. Yet, a weaker dollar also introduces an element of uncertainty. Exchange rates can be fickle, and what looks like a bargain today could turn into a costly mistake if the dollar continues to slide or if global conditions shift unexpectedly. It erodes the value of their investments when converted back into their home currencies. Even if the stocks themselves perform well, currency losses can eat into profits, making the final returns far less impressive than they first appeared. It's like finding a pot of gold at the end of a rainbow, only to discover it's filled with chocolate coins instead of the real deal. The initial excitement can quickly give way to disappointment if the currency math doesn't work out in their favor. So, will foreign investors embrace the allure of discounted American stocks or retreat to the safety of their own markets? The decision isn't always clear-cut. Some may see opportunity, while others may fear further losses and choose caution instead. It's a delicate dance driven by a complex interplay of factors, and no one can predict their moves with absolute certainty. In the end, the global marketplace is a stage where every investor must weigh risk against reward, and sometimes the boldest moves come from those willing to embrace a little uncertainty. The tale of the US dollar is a long and winding one, filled with twists, turns, and more than its fair share of drama. From its earliest days, the dollar has been at the heart of American life, shaping the way people live, work, and dream. It's more than just a piece of paper or a coin. It's a symbol of hope, ambition, and sometimes cautionary tales. Did you know, for instance, that the very first US dollar minted in 1794 featured a woman? Not just any woman, but Lady Liberty herself, a powerful emblem of freedom and possibility in a young nation still finding its way. Yes, indeed, Lady Liberty herself graced the coin, a far cry from the stern visages of presidents we see today. Her image was meant to inspire, to remind Americans of the ideals their country was built upon. Liberty, justice, and the pursuit of happiness. And what of the stock market? That bustling hub of commerce and speculation, where fortunes are made and lost in the blink of an eye. Ah, that grand casino of capitalism has seen its fair share of booms and busts, often mirroring the fortunes of the dollar. The market's wild swings have echoed through history, shaping the lives of millions and reflecting the nation's ever-changing mood. Remember the roaring 20s, that era of jazz, flappers and soaring stock prices? It was a time of optimism, innovation, and a belief that the good times would never end. The dollar was strong then, a symbol of American prosperity. People felt invincible, and the nation's wealth seemed limitless. But then came the crash of 1929, a stark reminder that what goes up must eventually come down. The bubble burst, and the dreams of millions were shattered almost overnight. The dollar tumbled, the market crashed, and the world plunged into the Great Depression. Breadlines stretched for blocks, and hope was in short supply as the nation struggled to recover. A sobering lesson, wouldn't you say? It was a time that taught Americans and the world about the dangers of unchecked optimism and the importance of resilience. History, as they say, may not repeat itself, but it often rhymes. The cycles of boom and bust, hope and despair seem to echo through the decades, reminding us to pay attention to the lessons of the past. Understanding the past can offer valuable insights into the present and perhaps even provide a glimpse into the future. By studying where we've been, we can better navigate where we're going and maybe, just maybe, avoid repeating the same mistakes. That is the question. So, dear viewers, we've explored the intricate relationship between the weakening dollar and the American stock market. We've witnessed how it breathes life into some companies while stifling others, how it entices foreign investors with the promise of bargains while simultaneously injecting a dose of uncertainty. The question remains, should you, armed with this newfound knowledge, rush to your broker and buy American stocks? If only the answer were that simple. Investing, my friends, is not for the faint of heart. It requires careful consideration, a long-term perspective, and a healthy dose of prudence. A weaker dollar can create opportunities, but it also carries risks. It's a balancing act, a delicate dance between potential rewards and inherent uncertainties. In the grand tapestry of finance, the relationship between the US dollar and American stocks is a complex and ever-changing pattern. There's no simple answer, no magic formula to predict the outcome. It's a mixed bag, old boy, a mixed bag. A weakening dollar can provide a tailwind for certain sectors, boosting exports and inflating the profits of multinational companies. It can also attract foreign investment, seeking value in the vast landscape of American assets. However, it's crucial to remember that a weaker dollar also casts a shadow, increasing costs for importers, potentially fueling inflation and introducing an element of currency risk for foreign investors. The key, as with most things in life, lies in balance, in understanding the nuances, and in making informed decisions based on your own individual circumstances and risk appetite. So tread carefully, my friends, and may your investment journey be both profitable and enlightening. Subscribe for more videos like this, and thanks for watching.